Why do most dividend investors fail? I want to take 7 reasons why most dividend investors fail and what you can do to be a successful dividend investor. Hi, my name is Jeff Wright. I'm president and founder of Fish Creek Capital in Birmingham, Alabama, where we focus on dividend growth and dividend growth investing. Let's quickly go through these 7 reasons. Number 1, chasing yield. Many investors go straight for the highest yield, 8%, 10%, sometimes it can be 12%. But that doesn't always equate to a good company. Bigger is not always better. Sometimes the high yield can mean high risk, which is not the purpose of dividend investing. Sometimes it can mean a company's in distress or they have unsustainable payout ratios. You can actually look at the cash payout ratio on a balance sheet of a company, and it will tell you how much cash they're using to pay out the dividend. Very important number. If you don't know how to do that, ask me below in the comments. Number 2, ignoring dividend growth. That's what we focus on here at Fish Creek Capital. We love dividend growth because it works. It works over the long term, whether you're rich or poor, young or old. Dividend growth works. So you want to focus on the growth of the yield, just not the raw yield. A 3% dividend that grows 10% per year can outperform a stagnant 6% yield over time. Again, if the earnings are growing from a company and they can distribute some of that cash back to the shareholder in the form of the dividend growing, that's often a good sign, because if the earnings are growing, the dividend's growing, that typically means the price of the share is also growing over time. So that's what you want. Growing earnings, growing dividend, growing share price. Number 3, not reinvesting their dividends. This is a huge mistake that a lot of people make. You've got to make sure that your dividends are being reinvested. There's dividend reinvestment plans or programs that companies will have. And then make sure you check your broker also, because oftentimes it'll default to just paying the dividend. And again, that's not what we want. We want that dividend reinvested to take care of compounding and take advantage of compounding. So like even on Interactive Brokers, you need to go in there and check and make sure that the dividend is being reinvested. Very important. Make sure you're reinvesting your dividend. Number 4, not understanding the business. If you don't know how a company makes money, that means you're guessing, you're gambling. That's not how you make money in the stock market. You want to make sure you understand the company. You know, Warren Buffett always said that. He did not invest in anything that he didn't understand. Great rule to live by when it comes to investing. Look for durable, cash flowing businesses, good management, strong moat, easy to understand. Don't just guess, don't gamble. Number 5, overconcentration. You don't want to be too diversified, because I think that just limits your ability to have good growth and good growth on those dividend payments. But you don't want to be overconcentrated either. So you want to make sure that you do diversify across sectors, utilities, consumer staples, financials, banking. But you don't want to have 200 different stocks either. We can help you look at your portfolio. If you'd like help with that, please click on the link below and schedule a free consultation for us to be able to give you our opinion on what your portfolio looks like as it comes to diversification. Number 6, timing the market. Don't try to time the market. You can't do it. I promise you. Don't focus on buying the bottom or selling the top. Again, you want to go back to number 4. Understand the business. Know what you're investing in. You do want to make sure the price that you're paying is a fair price, a good price. Price does matter over the long term. Don't try to time the market. We can help you learn how to do this as well. And finally, number 7, don't ignore the tax implications. Dividends can be qualified or non-qualified payments, and the rate will change based upon your income and how high your income is. So don't ignore the tax implications when you're deciding on what dividend companies to choose. It does matter. You want to make sure you pay attention to that. Thanks for listening. If you do like videos like this, please subscribe. Please click on the like button. If I can help you look at your portfolio, please click on the link below in the description for a free consultation. Thank you for watching. Have a great day.